So hello all my dearest students of full English. I hope you all are doing good. I hope your studies are going on great for your upcoming exams of November 2024. So here we come up with our final compilation which is relevant for your November 2024 exams. And what is this compilation all about? Let me give you a brief idea about exactly what this compilation is. You all already know that I have already made a compilation of 23 papers for you all, including 8 RTPs, around 10 MTPs and then exam papers. So those 23 papers which I have already made for Hindi students separately and for you all in full English separately, as you have always demanded from me. And I am very happy when you demand. When I put a video in Hindi and you guys say that sir please in English, that motivates me, that makes me very happy that the students love me so much that they want this particular video also in English. It's not an easy task to again and again record the same thing in two different languages, but you guys motivate me like anything. So thank you very much for motivating me always. So today what we are going to do is whatever RTPs and MTPs that came after May 2024, we are going to compile that today. So what came after May 2024 is November 24 RTP, November 24 MTP Series 1, MTP Series 2 and May 2024 exam papers. So we are going to compile these four things over here in full English for you all. Now, when we will be compiling these things, especially the MTP part, the MTP part, MTP Series 1 as well as Series 2, both of them are more than 90% repetitive in nature. So if there is any question which is repetitive in nature, I may not speak about that once again. It's not that I don't want to speak. I can speak. It will hardly take few minutes for me to speak, but I don't want to waste your time, especially in respect of those questions which are exactly similar to each other. So in MTP1 and in MTP2, you will see of November 2024 series, which is supposedly a fresh MTP, but it is completely copied from the earlier papers or earlier RTP or earlier MTP. So we will be not doing those particular questions because that is already covered in our 23 compilations paper. Okay. So let us start without wasting any further time. The very first question over here is on total income. Now, this is an Indian company engaged in manufacturing of pharmaceutical products. And what are we supposed to do over here? It's a beautiful question, very beautiful question. They have asked total income of the company and also they have asked optimum tax liability. Now, if they have asked optimum tax liability, we have to do multiple calculations. First, we will do calculation as per the normal provision. When you will do the calculation as per the normal provision, in that you have to make two calculations. One as per the regular provisions of the income tax law and one as per 115 JB, that is the MAT provision. And then whichever is higher, this will become your tax number 1. Then you will also go for alternative tax regime under 115BAA. This will become your tax number 2. And then out of these two, whichever is lower, that will be the optimum tax liability for us. Okay. So first of all, I am going to discuss the normal provision, the regular income tax, how we compute total income as per the regular provision. I am going to solve the question as per that first. Then I will go to book profit and then I will go to 115BAA. So let us start the question. The assessee is an Indian company engaged in manufacturing. Therefore, you need to be careful about additional depreciation. The assessee has paid 66 lakh rupees for public issue of shares. Even though it is non-clearance has been done by the SEBI. SEBI is not giving any clearance. It doesn't matter. If you incur any expense for public issue of shares, it is a capital expenditure. It is for the permanent capital base of the company. Therefore, it is disallowed. Okay. Second, the assessee is purchasing some goods from Sunny Traders, which is a micro enterprise, and it was purchased on 25th of Feb. The assessee has promised that it will pay in 25 days, but it did not pay in 25 days. It made the payment beyond 25 days. So, if you buy any goods from MSME, that is micro or small enterprise, and if there is an agreement between both of them, then you have to pay within the agreed period or 45 days, whichever is earlier. Here the agreed period is for 25 days. So I have to pay in 25 days. So if I pay within the time of the MSME, then it will be allowed on accrual basis. But if I pay beyond the time, then it will be allowed on payment basis. Now I have paid beyond the time. I have paid after 25 days. But fortunately, this beyond the time limit also comes in the same financial year. So even though it is allowed on a payment basis, it is allowed to me in the previous year 23-24 only. If this date would have been fallen in April, then I would have got the deduction in the next year, not in the current year. I hope it is clear to all of you. Let's move on to the next one. A pharma company giving freebie to medical practitioner disallowed as per section 37(1). It is bad in law. It is not allowed. 37(1) disallows that. Next. Depreciation as per Companies Act will be added back. Next, one-time license fee, it is not a capital expenditure. It has to be added back and then reduce 25% depreciation as per intangible asset. Because the asset is put to use for more than 180 days, you can take full depreciation. Okay, next. You have some warehouse in rural area for storage of sugar. From that, you are earning a profit of 17 lakh rupees and you have credited that to P&L. So do one thing, reduce from here and show separately under 3580. Don't mix your 3580 business with this particular business. Okay, pharma business is separate, 3580 business is separate. Don't mix both of them. Next one, you have received some power subsidy and it is to be adjusted in the electricity bill. So the power subsidy will be taxable in the year in which it is received. So you have received in the current year, so it is taxable in the current year. Now since it is already credited to the P&L, there is no need to give any effect to it. Okay, it is already credited to the P&L, there is no need to add or less anything. Next is a very simple question of grandfathering. I have already told you in the total income adjustment lecture also that whenever 31st Jan 2018 will come, grandfathering is applicable. So 4,80,000 is the profit reduced from P&L and then apply grandfathering. How to apply? Because the SSC has said that the question says that it is STT paid, therefore it is a listed share under 112A. Therefore, how will you compute the cost of acquisition? The actual cost compared with lower of FMV on 31st Jan or what? FMV on 31st Jan or what? Sale consideration, whichever is lower compared with the actual cost and then whichever is higher. Now, how to take the FMV on 31st Jan? It will be the highest price. Whatever is the highest price on 31st Jan, that will become the FMV. Okay. So accordingly, you do that. Now, you have taken a loan of 8 lakh rupees from PNB for working capital requirement. Now, that loan is waived by the bank. The bank has waived that loan. So, the principal portion which the bank has loaned, it is chargeable to tax under 41(1). The principal portion which is waived by the bank for working capital loan, it is deemed to be income under 41(1). It is a remission or cessation of a trading liability. And the interest portion which the bank has waived, that is not taxable because that was not allowed as deduction earlier. So, do not take interest as an income, reduce that from the profit. And let this be that principal portion is taxable, therefore let it be part of P&L account. Next, you are hiring some additional employees. 50 new additional employees are hired on a regular basis. Regular employees are there, and you are employing on 1/7/2023. You are paying them salary of 23,000 rupees per month, and all of them participate in recognized provident fund, and the wages are paid by account paycheck. You are fulfilling all the conditions of 80JJAA. Therefore, 50 employees into 23,000 into 9 months, because the employees are employed for more than or equal to 240 days, into 30%, that will be your deduction under 80JJAA. Okay, now remember 80JJAA is also allowed under 115BAA. So when you compute 115BAA, even in that case 80JJAA will be allowed. Next one, the company has invested 40 lakhs in the warehouse for storage of sugar. Out of that, 25 lakhs is your land. Therefore, only 15 lakhs will be allowed as deduction. Land is not allowed as deduction under 3580. Therefore, 17 lakh is your profit, which we have already seen above. Minus 15 lakh is your deduction. Therefore, 2 lakh rupees will be chargeable under what? As a 3580 business profit. Next, depreciation as per income tax rules, you can reduce that. And the company's turnover of last to last year is 395 crore, sorry. The last to last year turnover is 395 crore. Therefore, the tax rate of the company will be 25%. So take 25% tax, then check if the income crosses the surcharge limit, then apply the surcharge also if it crosses the surcharge limit, and then apply the tax rate. Okay, then apply the cess. This will be your first calculation. That is the calculation as per the regular provision. Now for MAT is very simple. They have directly given you the book profit 99.5 lakhs. Take 15% tax, don't take surcharge because the book profit does not exceed 1 crore. Take 15% tax and 4% cess. That's it. Your book profit MAT is already computed. Whichever is higher, that will become your tax number 1. Now in 115BAA, what will you follow? 115BAB is not applicable to assessee because the assessee is not fulfilling the conditions of 115BAB. You have to fulfill the conditions of 115BAB which the assessee is not fulfilling. So 115BAA will be applicable over here. So in 115BAA, everything will be same. The entire total income computed as per the regular provision will be taken here. Only one thing will be added back, that is the 3580 deduction. 3580 is not allowed in 115BAA. Rest all is allowed, whatever is there in this question. But on 3580, 15 lakhs building, you can claim normal depreciation on that. Normal depreciation you can claim. Additional depreciation is not allowed on building, therefore you cannot claim. Therefore, reduce that. Whatever income will come, that will be your income as per 115BAA. Apply 22% tax, 10% surcharge always. In 115BAA, surcharge is always imposed at 10% and 4% cess. That will be your computation, and then check tax number 2. And then whichever is more beneficial, you can go for that. Okay. So this is a beautiful question made by the institute. We should appreciate what you have done good. We will also criticize them for what they have done bad. Okay. Now question number next. XYZ is a partnership firm consisting of three partners, in fact, four partners, A, B, C, and D. D is a non-working partner. Now, they have given us some information and they have given us some details below. Additional information is also given below. And they asked us to compute two things. First, the firm do not want to get its books of accounts audited. The firm does not want to do audit and all. Then what does the firm want? The firm wants to compute total income. That's it, without audit. So let's see whether the firm can go for what? 4480. The turnover of the firm is 2 crore 80 lakhs. So can an assessee with a turnover of 2 crore 80 lakhs go for 4480? Yes, it can go as per the amendment made by Finance Act 2023. If the turnover is more than 2 crore but up to 3 crore, it can go for 4480 if the cash receipt is up to 5% of the total turnover. Therefore, the turnover is 280 lakhs. How much is the cash receipt? Let's check. The first cash receipt is 10,50,000. The second receipt is by way of check other than account pay. Remember, any check other than account pay check is also treated as cash only as per 4480. You can go and check. You can keep your books open when I speak the things. Please, you can verify that. So any check other than account pay check is also cash. So therefore, this 2 lakh is also cash. Therefore, total cash receipt is 12,50,000. Therefore, if I take the percentage, it is less than 5%. Therefore, the turnover for 4480 over here is 3 crore rupees. Therefore, the assessee can enjoy 4480. How to compute 4480? On 12.5 lakhs, which is received in cash, 8% will be the deemed income, and on remaining 267.5 lakhs, 6% will be the deemed income. Therefore, the total deemed income will be 17 lakh 5,000. Will I get deduction of interest from this? No. Will I get deduction of remuneration from this? No. No interest remuneration is allowed under 4480 for partnership firm. Will I get deduction of brought forward losses? Yes. Brought forward losses can be allowed from 4480 because that does not cover under section 28 to 44D. So whatever comes under section 28 to 44, that will not be allowed. No deduction of PGBP, no partnership firm remuneration, interest, nothing. But brought forward losses can be claimed because it does not come under 28 to 44. This is your first part. Second part, compute the total income for the AY 24-25, assuming that instead of 2 lakh rupees, the firm received 4 lakh by other than account pay check. Now, suppose this is not 2 lakhs, this is 4 lakhs, then how the things will change? The things will change drastically, let me tell you. If this is not 2 lakh, this is 4 lakh, then in the numerator, instead of 12.5 lakhs, it will be 280 lakhs. It will be 14.5 lakhs, sorry. So numerator is 14.5 lakh, denominator is 280 lakhs, therefore the answer will come to 5.17%. Therefore, your percentage is going beyond 5%. Therefore, you are not eligible for 4480 beyond 2 crore turnover. Now your turnover limit for 4480 is only 2 crore because your percentage crosses 5%. Therefore, you cannot take 4480. Now you need to compute your actual profit. Therefore, what is the net profit of the assessee? 8,65,000. I will write down that. Okay, 8,65,000 is the net profit. First of all, I will add back the interest which is in excess of 12%. So total interest is 15%. We are allowed only 12%. Therefore, add back 3% interest. 3% will come to 30,000 because the capital is 10 lakhs. Okay. Next, I will also add back the remuneration debited to the PNL. 60,000 is the remuneration paid to per partner into 4 partner into 12 months. That comes to 28.8 lakhs. Okay. This will also be added back. Then I will also add back the clerk's salary, which is more than 10,000 rupees in cash. So every month you are giving more than 10,000 rupees in cash to clerk. That is not allowed as per 48.3. Therefore, this 12,000 into 12 will also be added back over here. Okay. This is 1,44,000. This is already a loss. Now, apart from this, the assessee has also credited some capital gains to the PNL. The sale consideration is 57 lakhs. And the sale consideration is 57 lakhs. This 45 lakhs is with respect to this capital gains. And the cost of acquisition is 12 lakhs given in the question. Therefore, I will also reduce this 45 lakhs. Already the book profit is in loss. If the book profit is in loss, how much deduction you get for remuneration under 40B? Now everything will be allowed now. In part 1, he was following 4480. So we were not taking the deduction of remuneration and interest. But in part B, we are following the normal provision. So we will take all the deductions. So if the book profit is lost, how much deduction will be allowed to you? Only to the extent of how much? To the extent of, tell me how much? 1,50,000. So 1,50,000 I will take as a deduction of what? Remuneration. Then I will compute what? I will compute capital gain separately by taking indexation also. 57 lakh is the sale consideration of the plot of land, and then index cost of acquisition is 12 lakh is the cost, multiplied by 348 is the current year indexation, divided by the year of purchase whenever we have purchased that land, and therefore again there will be some capital gains over here. Now, can I set off the loss of PGBP against capital gains? Definitely. PGBP loss can be set off against capital gains, don't worry. But the brought forward loss of 75,000 of last year, that cannot set off against capital gains because the brought forward business loss can be set off only against business income. It cannot be set off against what? It cannot be set off against other incomes. Therefore, current year business loss you can set off against what? Business income. You can set off against capital gains income. But the brought forward business loss you cannot set off against capital gains income. This is how you are going to compute the question, and part B will be completed. Okay. Now coming to the third question, which is also a beautiful question. There is a real estate investment trust which holds 65% in H Limited. What is H Limited? H Limited is an SPV, special purpose vehicle. Now we need to talk about the taxability in the hands of REIT and also in the hands of an investor who holds 70% of the units of the REIT. So 70% of the units of the REITs are held by whom? Are held by the investor. So we need to talk about all the incomes one by one. Interest income from SPV. On this, REIT will not pay tax. It is exempt in the hands of REIT, but investor will pay tax on the 70% portion. Okay. Next, dividend incomes. REIT will not pay tax, and investor will pay tax or not. That will depend upon whether the SPV is following 115BAA or not. Now, in this question, it is very clearly written that the SPV has opted for 115BAA. So, if the SPV is opting for concessional tax, then the investor has to pay the tax on that. If the SPV would have not opted for 115BAA, then the investor would have not paid tax on dividend income. So on this dividend income, investor has to pay tax 70% amount, 2 crore into 70%, that comes to 1 lakh, 1 crore 40 lakhs, investor has to pay tax. Short-term capital gains on development property, REIT will pay tax at MMR, maximum marginal rate, investor is not liable to pay tax. Interest income from unlisted debentures, REIT will pay tax again at MMR, investor is not liable to pay tax. And then rental income, REIT is exempt. Whatever rental income REIT earns from direct investments in the property, REIT is exempt, investor is liable for tax. I hope it is clear to all of you. Now, the question doesn't complete here. There is a very beautiful amendment which is covered over here, made by the Finance Act 2023. Do you remember that? The entire amount, I'll tell you, it is the tricky one. The REIT has paid how much? 20 crore to its unit holders. Now, the 20 crore rupees is paid by the unit holder, by the REIT to the unit holder. Now, how much income is already taxed or exempt in either of the hands? 17.32 crore income is already taxed in the form of interest, or in the form of dividend, or in the form of rental income, or in the form of short-term capital gains or long-term capital gains, whatever it is. So that amount which is already covered above, okay, you have to reduce that. So how much it comes to? 17.32. How did you get 17.32? You can take a total. 12 crore plus 2 crore plus 1.2 crore plus 12 lakhs plus 2 crore. If I make a total of all this, it will come to 17.32 crore. So 17.32 crore is the total income of the REIT. Total income of the REIT, which on which some of the income REIT is paying tax, some of the income investor is paying tax. But the REIT is giving how much to the investor? REIT is giving 20 crore to the investor. Therefore, how much excess is given by the REIT to the investor? 2.68 crore. Out of which, how much is given to this investor? 70%. So the REIT is giving how much to this investor? 1.876 crores extra. 1.876 crore extra. And this investor has invested how much in the REIT? 1.5 crore he has invested. So as against his investment, he is getting 1.876 crore. Therefore, the differential amount, he is invested how much? 1.56 crore, and 1.876 crore is given back to him. So the excess amount is considered to be debt repayment by the REIT to the investor. It is considered as what? Debt repayment by the REIT to the investor. Therefore, this 3 crore 37 lakh 60,000 will be taxable under income from other source as per Finance Act 2023. I hope it is clear to all of you. Remember, this kind of question can come in the exam. Be very careful with this, okay? Now, the next question is a case law question of Bharti Cellulars Limited. What is exactly in this question? See, there is a cellular company, there is a telecom company, and there is a distributor. Now, telecom company gives commission to the distributor for selling the product. Now, whether the commission will be subject to TDS, always remember that depends upon the facts and circumstance of every case. If there is a principal-agent relationship between both of them, then the commission will be subject to TDS. But if there is a principal-principal relationship, TDS will not be subject. Commission will not be subject to TDS. Let me give you an example. I am a telecom company, you are a distributor. I am giving you SIM cards, and I am telling you, sell the SIM cards. Whatever SIM cards I will sell you, you will sell. I will give you 100 rupees for every SIM card. And if you are not able to sell the SIM card, give me back. Now there is a principal agent relationship. I am not insisting you to that you have to keep the SIM card. So in that case, I have to deduct TDS. It is commission. Second case, if I tell you take the SIM card, pay me this much money, and after that, if you are not able to sell, that is your headache, not my headache. You have to keep the SIM card with you. Now there is a principal relationship. You are not actually selling on behalf of me. You are actually purchasing the SIM card from me, and then you are selling. Therefore, in this case, TDS is not applicable. In this particular case of Bharti Cellular, second thing has happened. There was no principal agent relationship between both of them. There was a principal relationship, therefore TDS was not applicable. I hope it is clear to all of you. Okay. Now the next question is also a very important issue. The AO has surveyed the assessee at 9:30 p.m. Now, can AO survey the assessee at 9:30 p.m. after sunset? Generally, no. But if the business hours is in night, then it can. Now the assess's business hours are 5 a.m. to 10 p.m. and the AO is surveying at 9:30 p.m. Is the AO correct? The AO is absolutely correct. It's only that the AO has to take an approval from Principal Director General or Director General or Principal Chief Commissioner or Chief Commissioner. If he takes the approval, he is absolutely correct to go even after sunset. There is no need to go before sunset. If the business hours is in night, he can go. Second thing, the AO has entered the premise and he's taking the books of accounts and cash. Can he take the books of accounts in cash? First of all, if he wants to take the books of accounts, he can take the books of accounts. But if he wants to keep the books of accounts for more than 15 days, he has to take an approval. Without approval, he cannot take the books of accounts for more than 15 days. Up to 15 days, he can take without approval. But he cannot take cash under any circumstance under 133A survey. Survey section does not give you the power to seize cash and go. For that, you need to go and take a warrant from the higher authority and go and do search and seizure. So you cannot take away the cash in survey. Okay, that is wrong. Next one, state with reason the penalty leviable on each of the following independent circumstances. First, there is an eligible investment fund under 9A which has to file a statement. They have not filed the statement. So by when they are supposed to file the statement? They are supposed to file the statement within 90 days from the end of the year. Therefore, they should file the statement by 29th of June 2024. If they have not filed the statement, they have filed the statement late on 31st July. Therefore, they will be liable for a penalty of 5 lakh rupees under section 271 FAB. Under which section? 271 FAB, 5 lakh rupees penalty will be imposed. Check please. Okay. Second, Meena Caterers has received 1 lakh rupees in cash and 9 lakh rupees by account pay check on account of daughter's wedding. So can you receive 1 lakh rupees in cash? It is allowed, no issue. You can receive less than 2 lakh rupees in cash, there is no harm. If you are receiving 2 lakh or more in cash, then the provisions of 271 DA will apply and there will be a penalty imposed on you. So in this case, the assessee is not violating anything, therefore no penalty will be imposed. Next, the premise of the assessee was searched and there was an undisclosed income which was found to the extent of 18 crore. The assessee did not file any statement under 132.4. Now this is a question of 271 AAB. 271 AAB is specifically applicable for search and seizure case. If there is a search and seizure in your case, okay, if there is a search and seizure in your case and if the AO does what? AO found some income and if you say that this belongs to specified previous year and if you prove that it belongs to specified previous year during the course of search by filing a statement under 132.4 and if you pay the tax before the specified date, if you file the return before the specified date, if you fulfill all these conditions, then the AO will still impose 30% of undisclosed income as penalty. And if you violate any of the condition, that is if you don't file the statement under 132.4 or don't file the return on time or don't pay the tax and interest on time, then the AO will impose 60% of the undisclosed income as penalty. The assessee has not filed the statement under 132.4, therefore it is liable for 60% penalty. I hope it is clear to all of you. Okay. Now the next question is also a beautiful question on DTAA. Mr. Ram Prakash, a resident, aged 50 years. He has some business income in India and some other foreign nation. India does not have DTAA with country X and Y. We need to compute his total income and tax liability. So first of all, we need to take all the income and compute as if no DTAA, nothing is there. Compute everything in India. So first of all, he is earning rental income. On rental income, you will take 30% standard deduction. Okay, I hope it is clear. Also, you need to remember that he is paying tax under the default regime. Therefore, you need to keep those provisions in your mind. So first of all, he is earning what? He is earning rental income. On rental income, you will take 30% tax. Then 1,20,000, 1,30,000 is a loss in country X. So you can set off that loss against business income in India, no harm. Then business income 2,80,000, 3,40,000, 1,80,000. So all these losses you can set off against this business income and the net business income will be 5.5 lakhs. Then SCCG from vacant land is 10,80,000. You can put that also in the total income under capital gains. Then 37 lakhs is the long-term capital gains on sale of residential house. But immediately you have done what? You have purchased another residential house in Delhi in the name of spouse. Is it allowed? It is allowed. You can purchase in the name of spouse. It is allowed. Okay. So this 25 lakhs you can claim exemption under section 54 and this 12 lakhs will be subject to tax. Okay. It's a very beautiful question. Huh? Then 3,40,000 will be subject to tax under IFOS. 1,80,000 will be subject to tax under IFOS. 5,20,000 is not subject to tax in India. But you need to use this 5,20,000 while computing the tax and you need to find out the partial integration computation. You have to do it over here. How you will do? Now, this 5,20,000 agriculture income in India is not subject to tax. But while computing the tax, while computing the total income, don't take in that. But while computing the tax, remember step 1, all the incomes, including the agriculture income, compute tax on that. Then agriculture income plus basic exemption limit, step number 2. Then step number 1 minus step number 2, take the difference. That will be your tax. On that apply surcharge, cess, etc. And that will be your tax liability. You have to follow partial integration in this particular question. I hope it is clear to all of you. Is it clear? Now, once you do this, you will get what? You will get the Indian tax, and after that divide that by total income, you will get the average tax rate in India. Now what you have to do? You have to compute the average tax rate in country X and Y. Now there is a problem. The country X average tax rate is not given. So we have to compute that. How? Country X total tax divided by country X total income. Okay. So we have to compute that country X average tax first. Country Y average tax directly they are giving us 27%. But country X average tax rate they are not giving us. So what to do in that case? So let us see country X now. Country X, what all incomes are there? 2,50,000. We are now computing the country X total income. Country X total income will include what? 2,50,000 this. Then this loss, is this loss allowed in country X? Is this loss allowed in country X? Loss from the firm can set off against any other business, but not in country X. Country X, this loss is not allowed. So now don't take set off of this loss in country X, because now you are computing the tax of country X now. So don't take the set off. In that country it is not allowed. Then take the business income, then take the STCG, and then take the agriculture income also. Agriculture income is exempt in country X. In country X it is exempt, so don't take the agriculture income also in the total income. Whatever is the total income, then apply this slab rates on that. Up to 3 lakh no tax, then beyond 3 lakh up to 6 lakh 15%, and then beyond 6 lakh 22%. Take total income in the denominator, take tax in the numerator, you will get an average rate. And then compare that average rate with the average rate in India, and then check whether it is what, whether it is comparable or not, whether whichever is lower, apply that on doubly taxed income. So it's a beautiful question. Do this question before exam, it may come in the examination. It's a beautiful. This question was actually there in the paper 6C earlier in the elective paper. I have solved this in the elective paper for around 3 to 4 years, from 2018 to 2023, till the time the paper 6 was there. Now this question, that is the reason this question is by hearted to me. For country Y, there is no harm. Directly they have given 27% tax rate. So compare that with average rate in India, whichever is lower, apply that on doubly taxed income. Okay, I hope it is clear to all of you. So this is a beautiful question on what? On DTAA. Now the next question is, Peter is a company which is incorporated under the laws of USA. Now the global assets of the Peter are 50 crores and the Indian assets of the Peter are 25 crore. Therefore, because the Indian assets of the Peter are 25 crore and the global assets are 50 crore, it is 50% of the assets. Less than 50% of the assets should be in India. In case of Peter, exact 50% of the assets are in India. Therefore, Peter is not fulfilling the ABOI test. So if you don't fulfill the ABOI test, then what are you supposed to do? You have to follow, you have to check the other things, other factors, whether the poem is in India or not. So if we come to know that 10 board meetings were held, out of 10 board meetings, most of the board meetings are held outside India, only 4 board meetings are held in India. The key management and commercial decisions are also done where? The key management and commercial decisions for the conduct of the business are done in India. Therefore, we can say, because the key management and commercial decisions are in India, therefore poem is in India. Therefore, now the question is, if anybody pays any amount to them, if I pay to Peter INC a professional fees, then I will deduct TDS as per what? As per 194J or 195. Because Peter INC, is it a foreign company? Yes, it is a foreign company because it is incorporated outside India. At the same time, is Peter INC a resident company? Yes, it is a resident company also. So in 194J it is written resident, in 195 it is written foreign company. I should deduct TDS as per what? So the law says that in 115JH there is a separate notification which was notified in section in 2018, which says that if the company is both, foreign company as well as resident, you should deduct TDS, assuming that foreign company not as resident. Therefore, you will deduct TDS as per what? As per section 195. I hope it is clear to all of you. The next question is a very simple question, nothing great as such. Okay, it's a very routine question. B Limited holds 30% shares in a foreign company, therefore both of them are deemed to be associate enterprise. Okay, now it's a very simple question. You are selling to your associate enterprise at 10 rupees, you are selling to others at 12 rupees. So you are selling at $2 lesser, therefore 90,000 units into $2 into 85, that will be added back to your income. Similarly, you are taking some guarantee, you are taking some borrowing from your associate enterprise and you are paying a guarantee fee of 15,000, whereas to others you pay 12,000 rupees, $12,000 only. So you are paying $3,000 extra to your associate enterprise, therefore $3,000 into 85 will be added back to your income. Similarly, you are paying some you are paying some amount for getting some customers detail. 18,000 rupees are paid to associate enterprise, whereas to others you are paying only 16,000 rupees. So to associate enterprise you are paying $2,000 more, therefore $2,000 into 85 will become your arm's length, will be added to your arm's length price. Therefore these are the adjustments that you are going to make. Further, the question is, if AO makes this adjustment, whether the deduction under 10AA will be allowed. The answer is no. As per first proviso to section 92C, subsection 4, if AO increases your arm's length price, then no deduction under chapter 6A or 10AA shall be allowed to the assessee. Therefore, the assessee cannot claim what 10AA deduction on these items if these are added by the assessing officer. I hope it is clear to all of you. This is what your November 2024 RTP is all about, and it was a beautiful RTP. It covers some beautiful questions. So as beautiful as this, then as hopeless as the next one. Let's see the next one. This is the most hopeless. This is the most hopeless paper that you would ever see. MTP series 1 November 2024. 90% of the questions from this particular MTP are what? Are repetitive in nature. Let me show you which all questions are repetitive in nature. The very first question is absolutely repetitive, because you will not trust me, okay, that you are saying repetitive because you don't want to record the lecture. So I've given a reference. You already have the 23 paper compilation. You can go and check over there. I've given a reference, MTP series 2 May 24. It has been copied from there, okay. Second question, it's copied from MTP series 2 November 2023. Third question, it is copied from MTP series 1 May 2024. Fourth question, question number 3A. Now this they have not copied from anywhere, but this is a very simple question. So I will discuss that. Let's see what is happening in this question. A public charitable trust is there, which is covered under section 2LAB. It is earning gross income of 21 lakh rupees. Now, we will compute the income of this particular trust. 10 lakh rupees is received from the property held by the trust. So, I will write 10 lakh rupees first. Then 4 lakh rupees is received from business, which is incidental to the objects of the trust. So, I will add 4 lakh also over here. That is also subject to exemption because the business is incidental to the object. Then 7 lakh rupees is voluntary contribution from public. So, I will write that over here. Okay. Now, 21 lakh is the total income of the trust. From that, we all know that 15% flat exemption is available to the trust. Now 17.85 lakhs will be your what? Net income. From that I will do what? From that I will reduce whatever application I have done. What application I have done? I have done an application of 11.6 lakh rupees. But out of that, what has happened? I have made a repayment of loan of 3.6 lakh rupees, for which I have already claimed deduction earlier. So earlier, before 2021, you used to get deduction even on application of loan. I have taken a loan, I have incurred an expenditure. You can take deduction before 2021. But after 2021, it is not allowed. You all know that. You took a loan, you incurred an expenditure, not allowed after 2021. You have to repay the loan. But before 2021, disallowed. So out of 11.6 lakhs, 3.6 lakhs I have already claimed as deduction earlier in the form of application. Therefore, I will get deduction of only 8 lakhs. Therefore, 9.85 lakhs will become my total income, which is subject to tax. Now, the next question we have done a lot of times. You can check this. Okay, you are a hospital as well as you are a school. 3 crore you are receiving for hospital, 4 crore you are receiving for school. You have to aggregate both of them and check the limit of 5 crore. 100 times we have done this question. Okay. Next question also is similarly repetitive, same as MTP series 2 November 2024. November 2023, sorry. MTP, I am giving the references so that you should not raise any question to me that why you are not doing these questions with us. See, the level of comprehensiveness that we have done in the 23 papers now, that forces even ICAI to copy the questions from their own MTPs. Even they don't know what can be formed beyond these 23 papers. That is the magic of these 23 papers, that only a fortunate student can understand who have come across my video. All those who have come across my video, believe me, you are very fortunate about it. I'm not talking big about myself. I'm just talking what students have been saying me, what students have been giving me as a feedback. All those who have come across this video are literally fortunate, and all those who are not coming across this video, they are missing something very big in CA final direct tax. That I can say for sure, especially for South Indian students for whom nobody is making such kind of videos that we are trying to make, both in Hindi as well as English. You can just go and check what kind of video we have made for what MCQ case scenarios. Beautiful video. You can just go and check what kind of beautiful video we have made in 1 hour for total income adjustments. And the legacy continues with 23 papers, the most important video for your exams. Next one is Mr. Mukesh is an individual and he is doing a business. His last year turnover is 3.2 crore rupees. Now he is making payment of 3 lakh rupees for what? Residential house. So if I am an individual, my last year turnover is more than 1 crore rupees, and if I am making payment of 3 lakh rupees for what? For my house, whether 194C will apply, 194C will not apply, because 194C doesn't apply for personal purpose. Whether 194M will apply, 194M will also not apply, because 194M doesn't apply for more doesn't apply if the payment is more than if the payment is up to 50 lakhs. 194M only applies if the payment is more than 50 lakh rupees. Otherwise, it doesn't apply. Therefore, this transaction is not subject to TDS of 3 lakh rupees. Second, you are paying 75,000 commission for business purpose. Yes, year 194H will apply. Why? Because my last year turnover is more than 1 crore and I'm paying a commission of more than 15,000 rupees. Therefore, I'm liable to deduct TDS of 5% on the entire amount. Okay. Next one is also a same question which we have done in question number 35 of RTP. You can go and check over there. Okay. Next one is a simple question. Ms. S Limited took on sublease building from gym. We are taking on sublease building from gym and we are paying 20,000 rupees per month rent from September, and we are also paying higher charges for what? Higher charges for machinery. So the limit under 194I of building and plant and machinery has to be aggregated and then check. If the aggregate limit is more than what? 2,40,000, you have to deduct TDS. On building portion, you will deduct TDS 10%, and on machinery, you will deduct TDS how much? Of 2% only. I hope it is clear. Now, this question is again, it is just copied from the last RTP. Last RTP, you have copied that particular question. Okay, exactly same question. Okay, next question. This is also exactly same question. This is also exactly same question. This is also exactly question. This is also exactly same question, and this question is also exactly same question. All of them are repeated from what? From either earlier RTPs or earlier MTPs or either earlier exam papers. They don't have any innovation in their life. They are making this such kind of big institutes and they are making such hopeless kind of MTPs. Okay, such hopeless MTPs, very hopeless, very or whomsoever is making this MTP and listening to me, have some shame please. Okay, before making such kind of MTPs for CA final students. Anyways, coming back to MTP series 2 November 2024. In this first question is not exactly repeated, but most of the adjustments are repeated, but still I will discuss with you all as I promised. Even if one of the adjustment is different, I will discuss the entire question. I will only strike off the question if the entire question is repeated. Otherwise, I'm not striking it off. Okay, so this question, as you can see, when you will see this question, when you will listen to the question in the next 10 minutes, you will come to know that all adjustments are repetitive. All adjustments. Maybe the question is not in the same format. Maybe the adjustments are juggle up here and there. So this is also they have copied from the earlier question only, but they have taken 2 adjustments from this question, 3 adjustments from this question, 4 adjustments from this question, and made one question. Now we need to solve this question as per what, sir? As per the normal provision, don't follow 115 BAA and all. Don't follow all those things. Okay. Therefore, the SSC is engaged in production. 72 lakhs is the profit of the SSC. Depreciation is 24 lakhs. You have to add back the depreciation as per books of accounts. And interest on advance tax, it is not allowed. It is interest on income tax is disallowed. Then you are including some interest and borrowing cost in the opening and the closing stock. You should not do that. You should not include opening interest in the opening and the closing stock. You have included 7 lakh interest in the opening stock and 9,50,000 interest in the closing stock. So the differential amount is how much? 2.5 lakh that I'm adding back to the net profit. Okay, so that I can nullify that particular item. Next one, you are paying total 41,000, out of which 22,000 cash is paid for procuring dairy farming product from the producer. It is exempt. If you want to buy some dairy farming product from the producer of the dairy farming, it is covered as an exception in rule 6DD, therefore you can pay that. Next, 19,000 you have paid towards printing and stationery items. That is not allowed. More than 10,000 rupees disallowed under 40A3. Next, you have paid some 3,50,000 to a contractor. TDS not deducted. 30% expenditure will be disallowed. Okay. Next one, you have incurred some 35,000 rupees expenditure towards earning income from transfer of carbon credit. Now, whatever expense you earn for transfer of carbon credit, that is disallowed under 115 BBG, and transfer of carbon credit is separately taxable at 10% under 115 BBG. Definitely, if there is an expenditure, later on there will be some income also, which we will see after some time. Contribution to electoral trust 3 lakh rupees by check, so that will be disallowed under PGPP, and under 80 GGB you can claim the deduction because you are following the normal regime and the payment is made by check. Okay. Next one, advertising in a brochure of a political party is disallowed under PGPP under 37(2)B, but you can claim that as a donation under section 80 GGB. So disallow here and claim under 80 GGB. Next, you are taken some loan from cooperative bank, interest on loan, but that interest is not paid, therefore disallowed under 43B. Okay, you have to pay till the due date of filing of return. Next one, you are making some contribution to the pension scheme of employee, 1,50,000. So if you contribute some pension amount to the pension scheme of the employee, it is allowed as reduction to the extent of 10% of the salary. Now, what is the salary of the employee? The salary of the employee is 10 lakh rupees. The eligible salary is basic salary plus DA in terms. It is 10 lakh. You are paying what? 1,50,000. Therefore, only 1 lakh is allowed. 10% is allowed. 50,000 will be disallowed under the income tax law. Next one, you are receiving some unrealized rent of 3,80,000. First of all, I don't understand why the hell they are asking such kind of questions in the paper. Why? Because you have yourself removed what? House property and salary chapter from the study material. Then how the hell you are asking such kind of questions in the MTP or RTP or in exam paper? You cannot ask such questions in the exam, or else you keep those two chapters in the syllabus, put that in the study material, put that on the website, student will study and come. You cannot expect the student to remember all those things. Some things they might not remember if they don't study. Therefore, they should not put such things in the paper also. But unfortunately, this is what ICI is. They have put this particular thing over here. Unrealized rent. What is the treatment of unrealized rent? Unrealized rent is taxable whenever it is received. Whenever it is received, it is taxable. Yes, subject to flat 30% standard deduction. So you reduce from here, you reduce this unrealized rent from here. Okay. You reduce this unrealized rent from here, show under house property, take 30% deduction and pay the tax on that. Next one, if you receive any dividend, reduce from PGBP income, show under IFOS. Okay, I hope it is clear. Next one, you are importing some machinery. And on which there is a foreign currency loan. You have done some hedging contract and then there is from foreign currency loan and there is a profit of 3 lakh rupees on that. So there is a profit of 3 lakh rupees on payment. So this is the classic case of section 43A. When you import a machinery and there is a foreign currency loan or there is a hedging contract, anything like that, and there is a loss or profit on what? Loss or profit on what? On on payment, then that loss and profit should be adjusted to the WDV of the block of asset. So reduce this 3 lakh rupees from the PGBP and take that under what? And take that as a part of what? Cost of asset. And then you can do what? You can take normal and additional depreciation as the case may be on that. Next one, you are earning some interest from fixed deposit. What has to be done with that? Net of TDS 10%. So reduce 1,35,000 from the PGBP income and gross up and show under IFOS 1,50,000 rupees. Okay. Next one, income tax rules depreciation is 28 lakhs. Next one, the last year some expenses were allowed on due basis, but how much expense? 35,000 expense was allowed on due basis in the last year, but in the current year you are making a mistake by paying in cash. Therefore, that will be disallowed in the current year. It is deemed to be income under section 40A subsection 3A. Next, similarly, last year some audit fees were provided in the books of accounts on which TDS was not deducted in the last year. So last year 30% would have been disallowed. In this year you have paid the TDS, so take 30% deduction in the current year. I hope it is clear to all of you. And last but not least, income from carbon credit of 4 lakh rupees included in the net profit. So reduce from PGBP and show under what? Show under separately under PGBP or IFOS as the case may be. The institute has said that you can take under PGBP also, you can take under IFOS also, but you won't get the deduction of expenditure which you have disallowed earlier. Okay, that's it. This is what this question is all about. Now most of the question after this is repetitive in this particular MTP as well. This question is completely repetitive as question number 9 of RTP 2021. Next question is a simple question on DTAA, which is also completely repetitive only. It is repetitive from some or the other way. You can check. It's a very simple question on DTAA. I'm not interested in that. Okay. Next question is also MTP series 2 November 2023 question number 3. Just check. This is also repetitive. Okay. Now the next question is not repetitive, so I will just discuss with you all question number 4A subpart 1 and subpart 2. Okay. Now the first question over here is Kite LLP is withdrawing 68 lakh cash from the bank for buying some agricultural product from the farmers and 58 lakhs for the purpose of other business. The total, and the Kite Limited is Kite LLP is also filing the return regularly. Therefore, the total withdrawal by the Kite INC is 126 lakhs. The Kite LLP is filing the return regularly. Therefore, the limit of TDS under 194N for Kite LLP is 1 crore. Now, 1 crore, in excess of 1 crore, 2% TDS will be deducted by the bank. Therefore, on 26 lakhs, the bank will deduct TDS. Sir, there is some exemption, na, sir? If you withdraw the money for paying to farmers, no. That exemption is not for you and me. That exemption is not for Kite LLP. That exemption is only for what? It is for registered commission agent. If I am a registered commission agent and if I withdraw from the bank for buying agricultural product from the farmer, then 194N is not applicable. That is not available for you and me. Okay. Next one. If you are paying some interest of 98,000 rupees on capital bond issued by the Power Finance Corporation to Mr. Ajay, a non-resident, yes, you will deduct TDS under 195. Under 195 for non-resident, you have to deduct TDS under what? Under 195. Now this question is a repetitive question. The next question is not repetitive in nature, but that is also I have seen somewhere, but I am not able to find a reference of that. So I will discuss with you all. It is a good question, but this question is absolutely repetitive. It is absolutely repetitive. Same as MTP for series 1 May 24 question number 4B. You can go and check over there. Next question. It's a good question. Question number 4C. There is a P&L account for 2 years 22, 23, 23, 24. And we need to find out the PGBP income of the SSE. We need to find out how much interest will be allowed to the SSE and then find out the PGBP income of the SSE. So pay attention for the same. We need to find out EBITDA for the same. What is EBITDA? Gross profit minus whatever is the interest, that will be the EBITDA, because after that interest is there, depreciation there, tax is there. So we want the profit before that now. We want profit before that. The EBITDA is what? This minus this. 2030 minus 390 will be EBITDA. Okay. Now, how much interest is disallowed under 94B? Point number 1. Whatever is the interest, 390 minus 30% of EBITDA, compare with what? Interest paid or payable to associate enterprise, whichever is lower will be what? Disallowed under 94B, and the balance will be allowed. Okay. And then you compute what? Your PGBP income. In second year, what will happen? Whatever interest is disallowed in the second year, in the first year, sorry, you again compute the EBITDA of the second year. Again compute what? EBITDA of the second year. Take 30% of that. Take 30% of that. Whatever comes as 30%, first take 402 lakhs deduction, and then whatever, suppose 30% comes to 500 rupees. Suppose. So take 402 crore deduction from the current year, and the balance 98 crore deduction you can take from the disallowance of the last year. This is how you compute disallowance. When you carry forward the disallowance in the next year, you take within the limit of 30% deduction out of it. Okay. No harm in that. Next one, all of them are again same question. This is the same question. This is the same question. You can check it over here. This is the same question. This is the same question. Okay. No, this is not the same question. This is the question on tax audit report. So I will discuss this. This is also a same question. We have done 5 to 6 times at least. It is very important. I agree. All these questions are very important. I absolutely agree. ICI has deliberately selected only those questions which are very important, but they have repeated the question. They are not asking some new question. They are repeating the questions again and again and putting in the MTPs. Okay. Now, this is also asked many times. Now, this is a new question. This one is also a new question. 6A is also a new question. 6B is also a new question. 6A is a very important question on tax audit report. So there was an assessee, TMP Limited, is engaged in transportation of building material. Okay. And is transporting building material for whom? To the contractors. It made payment for hiring dumpers for this purpose. Now the company has not deducted the TDS. Okay. The auditor is of the view that it is a contract, therefore 194C is applicable, and auditor is giving a reference of a judgment of a Gujarat High Court. Okay. So the assessee is saying that it is not subject to TDS, but the auditor is saying that it is subject to TDS. What to do? What has to be done in this case now? In this case, the auditor, what is the responsibility of the auditor? That is what it is asked over here. The first responsibility is to refer under clause 34A. What is clause 34A? You need to report over here whether the TDS is required or not. Okay. If there is a debatable issue, then you need to write your opinion. You need to report that in the report. That auditor has a different opinion in this particular case. In clause 34A, you have to refer how much TDS is deducted, when TDS is deducted, when TDS is liable to deduct it, when TDS is liable to be paid, when it is actually paid, what is the number of delays in the date of payment, how many days delay has been made by the, you have to mention all those things. And if there is a difference in opinion, mention that I differ with the assessee. Then come to 21B. What is 21B? It is disallowance in case the TDS is not deducted. 21B talks about disallowance in case TDS is not deducted. If TDS is not deducted, then the expenditure has to be disallowed. You have to mention that. And if the CA does not do both the things, he will be guilty under second schedule of the CA Act 1949. So he will be guilty under, he has to do these two things. He has to report these two things. If these two things are not reported by him, he will be guilty under the CA Act 1949. I hope it is clear to all of you. Is it clear? Next one. Next one is a simple question, nothing great as such. There is a pharmaceutical company which was incorporated in 2001, and you have to make two calculations. One as per the normal provision, one as per 115BAA. How the things will change? In the normal provision, you will apply 25% tax rate because the turnover of last year is up to 400 crore. In 115BAA, you will apply 22% tax rate plus 10% surcharge plus 4% cess. But the difference, big difference will create from here. The big difference will come from here. The assessee has purchased some new plant and machinery of 12 lakhs. So under normal provision, you will claim additional depreciation, and under 115BAA, you are not going to claim additional depreciation. And then check wherever the tax liabilities come. That is the best option, and that is the most beneficial tax for the assessee. So this is what this MTP is all about. I hope it is clear to all of you. Now let's move on to the one last thing, that is May 2024 exam paper. The very first question over here is on total income question, and what they have asked exactly, let's check it. It was a very simple question. You are required to compute total income as per the normal provision. Don't follow 115BAA and BAB. Okay, so as per the normal provision, we are supposed to compute the total income. Let's start. It's an Indian company. Indian company is engaged in manufacturing, and the net profit is 95 lakh rupees. Okay, so first write down that. Depreciation as per Companies Act will be added back. Okay, next one. Next one is the Supreme Court judgment of Sassoon Chemicals. Now, what has happened in this particular case? The assessee was having some issues with the employees, and therefore there was some case which was going on in the court. So that was in respect of bonus. So whether how much bonus to be paid to the employees, there was a dispute in that. So what assessee did? Assessee made a trust and transferred the amount of bonus to a trust. The matter was resolved before the due date of filing of return. The assessee removed the money from the trust and paid to the employees before the due date of filing of return. So everything is done before the due date of filing of return. So whether that will be allowed as a reduction, the answer is yes. The court said that that will be allowed as a reduction. Check it please. Okay. Next one, the assessee is paying some regularization fee for violating the law. So if you pay any fee for violating any law that is disallowed under section 37, it will not be allowed. But if you pay any fee for violating a contract, that is called as a compensatory penalty. See, penalties are of two types. If a penalty is paid for violating a law, it is disallowed. If a penalty is paid for violating a contract, it is allowed. So next point, you are paying 45,000 rupees for failure to perform the contract. So you are paying some late fees, and that is allowed as reduction because that is a what? That is nothing but your compensatory penalty. Next one is a very simple question, simple adjustment, which has been coming for around 8 to 10 times in our 23 papers compilation. You are selling some land to a 100% subsidiary, which is a domestic company. So if a 100% subsidiary company, holding company, then capital gains is exempt. Condition is the recipient has to be a Indian company. The recipient has to be Indian company. The capital gains is exempt under 47. Therefore, remove this 7.5 lakhs from here and show under what? Show under capital gains as an exempt capital gains. Next one is again what? A grandfathering clause. In grandfathering clause, what you do? You take the highest price on the 31st Jan as your what? As your fair market value. Grandfathering I have already discussed in the earlier point. Okay, so remove this 4.5 lakhs and show the highest price as your what? As FMB as on 14 as FMB as on 31st Jan 2018. Next one, to pay the tax liability, you are giving a bank guarantee. Whether giving a bank guarantee is sufficient enough to take deduction under 43B, the answer is no. You have to actually make the payment. Only giving the bank guarantee is not sufficient enough to take the deduction. I hope it is clear to all of you. Next one, you are debiting an interest of 7.5 lakhs in the P&L, for which you have deducted the TDS on time and you have also paid the TDS before the due date of filing of return. If everything is done correctly, it is allowed under PGBP. Next one, you are paying some donation to electoral trust by way of account paycheck, so it is disallowed under PGBP and it will be allowed under 80 GGB because you are not following any alternative regime. In alternative regime, this is disallowed, but in normal regime, it is allowed if it is paid by check. Okay. Next one is a beautiful adjustment. You have purchased some imported machinery spare parts and you have debited to P&L and you have also included that in the closing stock. You should not have done that. Okay, you are taking that as a part of stock, so therefore it is wrong. But the problem is already solved. How? Because you have imported some machinery parts and you have debited to the P&L and you have also included in the closing stock, so therefore debit credit is nullified. Now what you are supposed to do is 1200 pieces of imported machinery spare parts you should add to the cost of machinery and claim normal and additional depreciation. So what is the price of machinery? What is the price of machinery? What is the number of units of spare parts? 1200 units you are buying. What is the unit per piece price? It is $25. And what is the rate on the date of purchase? It was 82.88. So therefore multiply this, whatever amount that comes, on that you claim normal depreciation and also the additional depreciation. Okay, nothing great as such. Next one, you are debiting some you have debited some P&L some depreciation in the P&L account 11.9 lakhs, which is already covered over here. 11.9 lakhs depreciation which you have debited. 9.1, they are giving the breakup of that. This includes some depreciation of 95,000 on firefighting equipments. No incidents of fire has taken place. So there is a firefighting equipment which is placed in my company. No fire has taken place. So will I not get depreciation on that? You will definitely get, because it's a passive income. It's a passive use. Depreciation under income tax law is allowed on passive use of the asset as well as the active use of the asset. So keeping a fire extinguisher or fire equipment for emergency services, it is considered to be passive use, therefore it is allowed. Okay, there is no harm in that. Next, you are purchasing a new machinery, so therefore you are purchasing a new machinery. Therefore on this you should take 15% normal depreciation and you should also take 20% what? Additional depreciation under the income tax law. Next, you have sold one machinery earlier. When you sold the machinery, at that time the WDV of the machinery was 35 lakhs and then you bought back that machinery for 65 lakhs. Remember, explanation 4 to 43(1) shall apply, that if an asset is sold by the assessee and then it is reacquired by the assessee, then WDV at the time of original transfer or reacquisition price, whichever is lower, that will become the actual cost. Therefore in this case, the WDV at the time of transfer was, original transfer was 35 lakhs, reacquisition price was 65 lakhs, therefore 35 lakhs will become your actual cost. On that you will claim 15% depreciation because the asset is put to use for more than 180 days. So this is how you will compute question number 1. Okay, a very simple question as such, nothing great in this. Now coming to question number 2, 2A subpart 1. 2A subpart 1. This is a very simple question. There is an assessee, Mrs. Seema Agarwal, aged 56 years, resident individual, and she buys a residential house in Ayodhya for 45 lakh rupees. So long back in 1993, she has bought a property for 45 lakh rupees. On 1/4/2001, the fair market value of the property is 1 crore 20 lakhs. The stamp duty value on 1/4/2001 is what? It is 1 crore 2 lakhs. Therefore, what will be the cost of acquisition? Remember, if a land and building is acquired before 1/4/2001, then the cost of acquisition will be actual cost compare with lower of FMV on 1/4/2001 or stamp duty value. Whichever is lower, that will be compared with actual cost, and then whichever is higher. So 45 lakhs will be compared with the lower of the two, and then the higher comes to 1 crore 2 lakhs, and therefore on that you will do the indexation. Okay, now we need to find out also the sale consideration. You are selling the property for 15,50,000. The stamp duty value is 17 crore rupees. It is not 15 lakhs, sorry, 15 crore 50 lakhs rupees and 17 crore rupees. Now if the difference between the two is more than 110%, then you will take stamp duty value. Otherwise you will take what? Full value of consideration as selling price. In this case, the difference is not more than 110%. Therefore the difference is less than 110%, or it is up to 110%. Therefore in this case you will take the selling price as what? As your FVC only. So it is very simple. FVC is how much? 15,50,000. Cost of acquisition 1 crore 2 lakhs into indexation. Do the indexation, multiply by this, divide by this, whatever is the indexation, and then that will be your long-term capital gains. Now to save this long-term capital gains, you are buying one plot of land of 8 crore and you are depositing 3 crore rupees in that for the purpose of constructing that plot. So therefore in all you are investing how much? To save capital gains on this house, you are investing 11 crore in another house. Okay, but 11 crore is not allowed from Finance Act 2023 onwards. Only 10 crore will be allowed under section 54 and 54F. The maximum exemption which is allowed is only 10 crore rupees. I hope it is clear to all of you. Next one is a very simple question. It is based on a case law of Pradeep Kumar Malhotra, which talks about gratuitous loan are covered under 222E. What Mr. Manju Meman has done. Manju Meman is a shareholder of 20% in a private company. Therefore this company is a closely held company. Now suppose if I am a shareholder in a private company, that is in a closely held company of 10% or more, and if that company give me loans in advance, then it is deemed dividend in my hand under 222E. That everybody knows. But I have done some favor to the company. What favor you have done to the company? It was let out. I have some immobile property. I gave that property on rent to the company, and I allow the company to keep that property as a collateral to obtain a loan. Against that, the company has passed a resolution and given me an advance of 20 lakh rupees, which will be eventually adjusted against rent only. Okay, so they are giving me 20 lakh rupees as what? Advance. So is it a gratuitous loan? It is not a gratuitous loan. A gratuitous loan means I give you a loan, the company gives me a loan without any favor in exchange. So if the company gives a loan to the shareholder without any favor in exchange, then 222 is applicable. Here the company is giving me loan, I am also doing favor for the company, therefore section 222E is not applicable in this case. So this is what this section is all about. Now the next question is 100 times we have done this question. Okay, but once again we have to do, because they have asked in the examination. There is a company by the name called as Miles Inc., which is in US. Okay, so it's a company incorporated in US. So whether the poem of the company is in India or outside India, still I don't know. Let's see the question. During the financial year 23-24, the shareholders met in India for how many times? They have met in India for 3 times. For what purpose? Are they dealing with some commercial and management decision? The answer is no. They have come over here in India to discuss the rights of the various classes of shares and to sell the assets of the company. Now, if the shareholders, if the directors meet in India to discuss the rights of various classes of the shares or to sell the part of the company, it does not amount to management and commercial decision. Therefore they are not doing anything which is related to what? Place of effective management. Therefore the poem is outside India, therefore the company was non-resident. If the company is non-resident, now accordingly we need to answer the following items. If a non-resident company is receiving some dividend of 5,50,000 rupees from home, on a global depository receipts. So on global depository receipts, if any dividend is received, that is taxable under 115 AC at how much percentage? 10%. But the problem over here is it is written as received. How many times we have done this adjustment? If it is received, you have to gross up. You have to say 5,50,000 is what? 89.6%, because 10.4% is the TDS which has been deducted by the company, which has been deducted by the payer. So what is received is only 89.6% gross up. Similarly, a fees for technical services is received. Again, you have to gross up. Generally, fees for technical services is taxable at how much? 20% tax, 4% cess, therefore 20.8%. Therefore, you have to gross up at 79.2% by reducing the tax portion. So 5,50,000 is received. So this is 79.2. The gross up is how much? Now, some people might raise a question that, sir, where is the agreement which is approved by central government. Sir, it is not mentioned now, therefore this FTS cannot come under 40, this FTS cannot come under 115A, this should be taxed at 40%. See, I agree. They have not mentioned that there is an agreement between the SSC and the other person. I absolutely agree to that. But approval is not required in case the government enters into an agreement with any person. Say if I am a government and you are a non-resident, you are providing me FTS, I am paying you money. Approval is not required. Approval is required only for residents. It's not required for government. Yes, agreement is not there. I absolutely agree. So alternatively, you can take 40% tax and you can gross up that also. That will also be the correct answer. But unfortunately, ICI has not done that. ICI has taken 79.2%. Okay. They have not given any alternate view on this. Now, coming to the next question, which is on what? Which is on taxation of trust. Now, this trust is doing some wrong activity. First of all, the trust is a charitable trust under 12AB. It has applied 4,50,000 rupees for the benefit of the trustee. So we need to compute how much income is taxable under 115 BBI as specified income, which is chargeable at 30% tax. Therefore, if a trust applies money on trustee, is it covered under 115 BBI? Yes, it is covered. So on 4.5 lakhs, the trust has to pay 30% tax under 115 BBI. Then a person has donated 3,75,000. Mr. Sujan has donated 3,75,000. We are giving favor to that person only of what? Of 2,50,000. So Mr. Sujan will be called as a specified person. Why, sir? Specified person under section 13(3). How, sir? Any person who contributes more than 50,000 during the entire year is called as a substantial contributor. And a substantial contributor, if you do favor for that person, that is also covered under what? 115 BBI. Third, you are doing some expenditure of 2,50,000 rupees in the current year by giving what? By making donation to another person, which is not allowed. Why? Because you have promised in the last year that you will accumulate this for a specified purpose and use it for the purpose of what? For the purpose of trust within 5 years. But unfortunately, you are not doing that. You are giving that as a donation to some other person. So you are making violation of section 11 subsection 2. So that will also be covered over here, and that will also be subject to what? 30% tax. I hope it is clear to all of you. Next one, there is a trust which was incorporated last year in 2022. Now they have commenced their activities in 2022, but in the last year, unfortunately, they failed to apply for a provisional registration. So in the last year, they did not apply for the provisional registration and they paid the tax as per the normal provisions. Okay, not as per the trust provision. In the current year, the trust wants to apply for the final registration. Can they do so? The answer is yes. This is an amendment made by Finance Act 2024 that if the activities of the trust is already 2023, sorry, not 24, 24 Finance Act is not applicable for your exams. So if the activities of the trust is already commenced in the last year, what I said, if the activities of the trust is already commenced, and now if the trust is coming for an application, there is no need to give for a fresh application for provisional registration. They can directly make a application for final registration. Yes, the trust is justified. Can a trust apply for the final registration before applying the provisional registration? The answer is yes. If yes, what is the time period? That is somewhere around 6 months, something is that you can just go through the provision. Okay, I hope it is clear to all of you. Now the next question is a very simple question on DTAA. 100 times we have done. Mr. Kumar, aged 56 years, you include this income from profession in India, include this also, include this also, include this also, reduce this expense. Don't take 80 QQB because in the question it is written that you have to follow the new regime. So if you have to follow the new regime, then you don't have to take the deduction of 80 QQB. Rest all the questions are adjustments are same only as what we have done in the 23 papers 100 times. Okay, so don't waste time on this particular question. Let's go ahead with the next question. Next question is on TDS. Very beautiful questions on TDS, but very simple questions on TDS. The very first question is, a hotel is there. A hotel is collecting service charge from the customers and paying that to the waiters. Okay, so a hotel is there. ITC hotel case law is applicable here. Hotel is collecting service charge on the customers and paying to the waiters. Whether TDS is applicable on that, the TDS under 192 is not applicable on that because there is no employer-employee relationship with respect to that service charge. There is no obligation on the company. There is no obligation on the hotel to pay to the employees. It is only payable if it is received from the customer. If the customer gives, we will give. If the customer doesn't give, we will not give. Therefore, this is not subject to TDS. We have already seen in the case law of what? ITC hotels. Next one, Lalit is an individual. The last year business turnover of the Lalit is what? 1.5 crore rupees, and Lalit paid 5 lakh rupees by check to an individual for constructing his factory. So whether Lalit is liable to deduct TDS under 194C? The answer is yes. Lalit is an individual. His last year turnover is 1.5 crore and he is making the payment for business purpose, not for personal purpose. If he would have made payment for personal purpose, 194C would have not been applicable. Then we would have checked 194M is applicable or not. But in this case, he is making the payment for factory purpose, therefore 194C is applicable, and he is making the payment to an individual, therefore TDS of 1% will be deducted in this case. Next is a similar question which we have done earlier also. Lalit is also paying some monthly rent of 16,000 rupees per month and is also paying some service charges for furniture. So whether we will aggregate both of them and check under 194I? The answer is yes. We will aggregate furniture also and land building also and then check under 194I. One thing you remember, for furniture also the TDS rate is 10%. For building land also it is 10%. It is not 2% for furniture. For plant and machinery it is 2% under 194I. For furniture and building it is, for land, furniture and building it is 10%. For plant machinery it is 2%. I hope it is clear to all of you. Next question is also a very simple question. There is a partnership firm who is selling some product through an e-commerce operator of 4,90,000 rupees, out of which 60,000 rupees is directly paid by the customer to the seller. 4,30,000 is paid by whom? Paid by customer to e-commerce operator, then e-commerce operator has paid to the seller. So whether TDS is applicable on both of them? The answer is yes. We have already done this kind of questions in the class, that entire amount will be subject to TDS, whether it is directly paid by the customer to the seller or either it is paid via the e-commerce operator to the seller. Both of them will be subject to TDS under 194O at the rate of what? 1%. Now one more doubts will come in your mind. Sir, 4,90,000 is below 5 lakh na? No TDS is applicable up to 5 lakhs? No. Don't be misunderstood. That exemption of 5 lakh is only applicable to resident, individual and HUF sellers. That is not applicable to others. That too if they declare their PAN or Aadhaar number. Otherwise even they will not get the exemption. Okay, I hope it is clear to all of you. Now the next question is a very simple question. There is Yatin Limited which is located in country X and it is a notified jurisdictional area, and Armo Limited is a domestic company. So we are a domestic company. We are entering into a transaction with a person located in NJ. So remember, whenever we enter into a transaction with a person located in NJ, then we both are deemed to be associate enterprise. Remember that we both are deemed to be what? Associated enterprise. Therefore Yatin and Armo are deemed to be associate enterprise. Therefore the transaction between both of them will be deemed to be international transaction. So to Yatin you are selling at 11.575 crore, and to others, to unrelated party, you are selling what? You are selling at 13 crore. So you have to follow cup method over here. 13 crore will be the price charged to the uncontrolled party. Then you have to make the functional adjustment. Two functional adjustments are there. One is with respect to freight and insurance, and another is with respect to some other items of 19 lakh rupees. Make these two adjustments, you will get the arm's length price, and then you will compare with your actual selling price of 11.75 crore. The difference will be considered to be, it will be added back under the transfer pricing. Okay, so it was a cakewalk question of 6 marks. May 24 students are very fortunate enough. I don't think so November 24 paper is going to be as simple as this. So don't worry about it. Whether a paper comes difficult or easy, don't worry about it. If a paper comes easy, you will get less marks. If a paper comes difficult, you will get more marks. Believe me, because the level of studies which you have done now with me, even through YouTube also, if you have not directly taken my batch, even through YouTube also, that is far better than anybody in this entire country. That I can say 100%. And if you also believe to that, please below comment and tell me, okay, whether you agree to my sentences or not. Now coming to the next question, which is on case law. Okay, so next question number 5, which is on case law. Let's talk about this question. The very first question over here is, Assassi has taken an engine on lease. Okay, now while taking the engine on lease from a foreign company, the foreign company does not have any PE in India. The foreign company also does not have any PAN in India. Therefore the associate deducted the TDS as per 10% under DTAA. Okay, between India and Germany DTAA, because India and Germany DTAA says that such foreign leases, such leasing of such engine leasing will be subject to 10% TDS. So associate deducted TDS as per DTAA. Now the AO is saying that no, you cannot deduct TDS at 10% because the other person has not given PAN. Therefore you should deduct TDS at what? 20%. So we need to answer whether that 20% provision is also applicable on DTAA or what, or it is only applicable to the income tax law. So the Supreme Court of India in the case of Air India Limited has held that this 20% higher rate of TDS not applicable to what? DTAA. Okay, not applicable to DTAA. This is only applicable when you compare the rate under the income tax law. So if the DTAA says that the tax will be chargeable at 10%, then it will be chargeable at 10% only, no matter whether the other person has filed person has a PAN number or it doesn't have a PAN number. It cannot exceed 10% under any circumstance. I hope it is clear to all of you. Is it clear? I hope it is clear. Now the next question is on doctrine of partial merger, etc. It is a question on CIT versus Tony Electronics Limited, or we have also done one more case law, Supreme Court in the case of Hind Wires Limited. So this question is on that. So let me read the question. The AO has passed an order on 20th of November 2018 and he has made a mistake. Sorry, the assessee has made a mistake. What mistake? Instead of adding depreciation, the assessee has reduced depreciation. So instead of adding 10 lakh rupees, the assessee has reduced 10 lakh rupees. Okay. Assessee had to disallow deduction depreciation of 10 lakh rupees. So by mistake, assessee has reduced 10 lakh rupees. So in short, assessee has made a mistake of 20 lakh rupees. Because instead of adding 10 lakh rupees, if you are reducing 10 lakh rupees, then your profit will reduce by 20 lakh rupees. Na? So assessee should rectify that. Now assessee failed that. This leads to double deduction. Assessee did not know about that. He mistakenly did that. Even AO did not find that mistake. Now later on, assessee went for an appeal with CIT appeal for some other issue, not for this issue. The CIT appeal had decided the appeal passed the order. Now the AO wants to what? Disallow this 20 lakh rupees. So now the question is whether this 20 lakh rupees, if the AO wants to disallow under 154, by rectifying under 154, whether the 4 years time limit will be counted from the CIT's 4-year order or it will be counted from the original order. Okay. Whether the 4 years time limit for rectification of mistake will be counted from where? From the CITs, when the CIT passed the order or when the original order was passed. So the High Court says in the case of Tony Electronics that Section 154 rectification has to be done within 4 years from the end of the financial year in which the order sought to be rectified was passed. And the High Court says that the order sought to be rectified need not be original order, it can be rectified order. So as per this judgment, the time limit of 4 years will be counted from here. Okay. Because order sought to be rectified means it has to be counted from here, not from the original order. But there is one more view which is taken by ICI, which we have also taken in the class in the case of ICICI Bank Limited Bombay High Court judgment or Supreme Court judgment in the case of Elegantron Finance Limited. That in that case, that was judgment was in respect of 263. In that judgment, it was said that the time limit of 4 years should be taken from here and not from here. Okay, so these two different views are giving absolutely different application to the assessee. In one case, the time limit will be counted from 23rd July. In another case, the time limit will be counted from 20th November 2018. Both the answers are correct. You can write either of them in the examination. It's all fine. Okay. Next one is what? There was an assessee domestic company in which there are 700 employees. It has to deduct TDS in respect of salary, contract payment, etc. Now in March 2024, the assessee deposited part of the TDS being 88 lakhs and 72 lakh was deposited later in July 2024. Okay. So assessee has deducted the TDS properly, but there has been some delay in depositing the TDS. Again, I am saying the assessee has deducted the TDS properly, but there has been some delay in depositing the TDS. Now the question is, if the assessee delays in depositing the TDS, whether the AO can impose penalty under 271C? The answer is no. The court had said that answer is no. US Technology International Private Limited, the court has said that section 271C is only for delay in deducting. It is not for delay in payment. Section 271C does not apply for delay in payment. It is only applicable for delay in what? Deduction. If the assessee has not deducted on time, you can apply 271C. Yes, if you want to apply, you can apply interest under 201 on the assessee. You can apply 201 subsection 1 interest for delay payment of TDS, but you cannot apply penalty under 271C on the assessee. Next few questions are theory questions that you can go through at your end. And one last question over here, let me go through. With that's a beautiful question on what? That is a beautiful question on tax audit report. Okay. So let's see what exactly has happened in this particular case and what mistake the chartered accountant has committed over here. There is a travel agent. Now this travel agent has remitted a lot of money outside India to Australia. Lot of money has been remitted to outside India. Now we all know that for foreign remittance, you have to take certificate from chartered accountant in form 15CB. Now the income tax department collected the data. Form 15CB is collected by chartered accountants and list of passengers, copy of their passport, date of travel, invoices, and they came to know that nothing has happened. All of them are fake. The income tax department contacted the passengers also. They also denied that we haven't gone anywhere. These are all fake documents. Then the income tax department came to a conclusion. Nobody went outside India. The amounts were remitted outside India for some wrong reasons. The amounts were remitted outside India for some what? Wrong reasons. So this is the FEMA violation, and Form 15CB being a vital document, the income tax department came to know from there. In all, around 35 crore of remittance was made outside India. Okay. So the income tax, the institute asked the chartered accountants, why have you done so? The chartered accountant put their point, put their view that we have checked all the documents, we have verified all the KYC documents, and it is not, he was not the statutory auditor, we were not the statutory auditor, so we did not examine the books of accounts. Okay, we are not the statutory auditor, we did not examine the books of accounts, we have just seen the KYC documents and we have passed, we have signed on the 15CB certificate. So is the CA guilty, deemed to be guilty? Let's see what is the Responsibility of the chartered accountant. Chartered accountant has to examine the books of account. He is saying that I have not examined the books of accounts. He is wrong. He should examine the books of accounts before signing a remittance certificate. He should check the TDS rate. TDS, applicable TDS rate to be mentioned in the form 15CB. In 15CB, you have to mention the TDS rate also. Then he should verify the agreement between the parties to whom he is remitting. He need to check the agreement. But he has only verified KYC. He has not verified any other thing. Therefore, he is deemed to be guilty as per clause 7 and 8 of part 1 of second schedule. He is deemed to be guilty. I hope it is clear to all of you. And therefore, he will be liable for penal action against him by the institute. Next one, few questions with respect to whether it is tax planning, tax management or tax evasion. Let's see. There is one person, Mr. D, who has a fixed deposit of 50 lakh rupees in his name. Now what is he doing? He is gifting this 50 lakh rupees to his son. Okay, who is a major son, he is not a minor son. So he's gifting that 50 lakh rupees to his son, major son, so that his son does not have any other income, so that the interest income on that FD will be chargeable in the hands of the son, and the son claim what? Basic exemption limit. Because if the father receives the interest, he will be liable for tax. Is it tax planning or tax management or tax evasion? It is tax planning. Why, sir? It is not tax evasion? No. It is not a tax evasion. It is allowed under income tax law. Yes, if the son would have been minor son, and if it would have done, then it would be clubbed in the hands of the Mr. A, Mr. D. So this is allowed as per what? There is no clubbing also applicable on this case. This you can do with your major son. There is no harm in that. It is tax planning. Second one, Mr. Ram's annual income is 49.5 lakhs. He also earns some income of 6 lakh rupees. So if he add that income of 6 lakh rupees commission, if he add that commission also to the income, this will come to around 55 lakh 5,000, 55.5 lakhs. Therefore, what he's doing, he knows that the moment his income crosses 50 lakhs, he will be liable for surcharge. He knows that. So what he's doing, he is transferring this income in the name of his wife. He's telling the remitter that please transfer this 6 lakh rupees to my wife. My wife doesn't have any income, and please deduct the TDS also in her name. My wife doesn't have any income. Is this tax evasion? The answer is yes. I cannot tell you that pay the fees to some other person. I cannot tell you give the money into my wife account, give the money to my friend account. This is clearly a tax evasion, and therefore this is a case of tax evasion, not tax planning. I hope it is clear to all of you. And last but not least, there is a non-resident company who has entered into various contracts with Indian companies with respect for installation of mobile telephone system, and for this purpose they want to know the tax liability, and therefore they are making an application to board for advance ruling. So this non-resident has made an application for what? For knowing the tax liability with various Indian companies which he is transacting with. Similarly, some of the above companies have also made an application for what? For determination of question of law. So on the same issue, the non-resident is also making application, and some Indian companies are also making application. Therefore, now here there are two views which are taken by the institute. First, there is one point in advance ruling that if the application is already pending, then nobody can make an application on that. If your case is already pending in front of assessing officer or ITAT or income tax authority or High Court or Supreme Court, you cannot make an application. So here there are two views which are taken. The first view is the case is the AO is rejecting the application of the non-resident. The non-resident's application is rejected by the AO. Is he correct or wrong? Both the answers are correct. If he takes a view that the application should be pending in whose case? The application should be pending in assessee's case. Is the assessee's case application pending? Not pending. So he should accept that case. Let me explain you. It's a tricky point. It's a very tricky point. It has a long answer. See, the point which is mentioned in the law is if the application is already pending in front of the income tax department or ITAT or High Court or Supreme Court, you cannot make an application. For your application will be rejected from board for advance ruling. But whose application should be pending? My or application or anybody's application? There are two views. In first view, if assessee's application is pending, he cannot make second application. So in this case, assessee's application is not pending. The application is pending by some other Indian companies. So the first view is if assessee's application is not pending, the application should be accepted. The second view is if any other person's application is also pending, the assessee cannot give application for board for advance ruling. Both the views are given by the institute, and both the views are correct also. So this is what this question is all about, and this is what this paper is all about, and this is what the final compilation is all about. So ultimately we have done a compilation of 27 papers, and believe me, I don't think so the ICI can think beyond this. If they think beyond this, that is well and good. If they think beyond this, these 27 papers will help you. If they think beyond this, that will be more beneficial for you, because I don't think so anybody would have done direct tax so comprehensive as we have done it in these 27 papers. We have tried to cover every aspect that is possible, and tried to explain as fast as possible and as comprehensive, like as detailed as possible in these 27 papers. So I request you all only one thing: follow these 27 papers religiously, and follow our MCQ video religiously, and follow our total income video religiously. These three videos, if you see properly, 99% of the chance is there you will be easily through with the direct tax with good marks. I'm not claiming that you will get exemption. Everybody will get exemption. Everybody cannot get exemption. That also depends upon how you write the paper, whether you complete the paper, whether you write properly or not. But you will easily pass with these things, these three things. That's it. And if you like this, please comment below, share your views, that what exactly is your views on this video. And also please share with your friends who needs to learn direct tax in English, who needs help, and there is no enough help on the YouTube as far as English direct tax revisions and English such English videos, such how can I word that, such innovative English videos are not available on YouTube for direct tax. I don't think so. You guys only tell me. I don't see anything from my side. So take care all of you. Bye all of you. I hope you all will do great in your examination. Take care all of you.